Assalamu alaikum friends, welcome to lecture 25 of SBR, the IFRS 1 first time adoption of IFRS. From lecture 1 to lecture 24, we have finished our IAS series, that is IAS 1 to IAS 41. Now lecture 25 onwards will be all IFRS, starting with IFRS 1, then IFRS 2, IFRS 3 and so on. Okay, this standard from the point of SBR exam has a very low chance of coming. Okay, even if it comes, it is not calculation, it is as a part of a discussion question. Okay, and you just have to know some very brief points regarding this standard, and it's a very short standard. So pay, since the next week is your exam, your March 2023 exam, so pay close attention to those standards which has a very high chance of coming, and those standards which does not come in the exam or which have never came before, which has a very low chance of appearing in an exam, still prepare for them, but not with that intensity that you would prepare for standards like IFRS 3, which is your business combination, or your IFRS 15 revenue, right? But just go through it briefly. So let's start, and at the end of this lecture we'll be doing one question on IFRS 1 to show you how a question on IFRS 1 comes. Okay, but questions on IFRS 1 you would not see many. It's very rare. But still, since it is in your SBR syllabus, you have to go through it. In fact, you have to go through all the standards. You cannot skip any of it. Okay, because you never know if you are the one for which IFRS 1 comes. So be prepared. Starting with introduction, date of transition, which IFRS standards should be adopted, reporting gain and losses, explanation, exemptions, and the implications of adopting new accounting standard. So let's start with introduction. Now, this standard is for those companies that are planning to adopt to IFRS standard for the first time. That means before this time, they have been following the old accounting standards like US GAAP, UK GAAP. Now they are moving on to IFRS standard. So when they move on, there are 5 issues that need to be addressed. And you have to know these 5 issues only, that's it. Number 1, the date of transition. Very, very important is when are you transiting to IFRS standard, the date. Second, which IFRS standard should be adopted? Third, how the gain and losses that arises when you're adopting to IFRS standards should be accounted for. Fourth, explanations and the disclosure. Fifth, exemptions available. Don't forget these 5 issues, because throughout this lecture we are only going through these 5 issues only that we are going to address one by one, starting with the date of transition. The first issue, the date of transition is the beginning of the earliest period for which an entity presents its financial statements for the first time. Full comparative information. See the word comparative. How can you compare? See, to compare, you need 2 things. Can you compare if it's just one thing? No, right? You have to compare. You need 2 things to compare. So when it says comparative information means you need this year's information as well as the previous year. It is explained in the next point. When you are presenting your financial statement for the first time for the year ended 31st December 2008. See, year ended means when is it starting? 1st of Jan 2008. 1st of Jan 2008 to 31st December 2008. 12 months, right? This is the year you are going to adopt IFRS standard for the first time. But it is not the year of transition. Why? The date of transition is when the beginning of the earliest period for which entity presents comparative information. You have to go exactly 12 months back from 1st of Jan, not from 31st December 2008, from 1st of Jan 2008. 12 months back if you go, you land up to 1st of Jan 2007. That is the date of transition. Why do you need that? See, even to prepare financial statement for the first time, right? When you're preparing it for 1st of Jan 2008, you need the opening balance. And how are you going to get that opening balance? You have to get it from the closing. The closing balance of the previous year is your opening balance this year. You're understanding my point? So that's why you need a comparative information, and that comes from the previous year. From the year when you're planning to adopt IFRS standard, go one year back, 12 months back. That is the date of transition. This is how you work out. That is the first day of the comparative period, 1st of Jan 2007. Now, so an opening IFRS statement of financial statement should be produced as at the date of transition. At the date of transition, you are preparing the opening IFRS statement of financial position. But remember, you don't have to publish this statement, the one which you are doing at the date of transition. But you already need it to get the opening balance of 31st December for the year ended 31st December 2008. You already need the opening balance for the comparative period. Only for that purpose. So you need two financial statements. Which IFRS should be adopted? Second issue was this, right? Date of transition is over now. Second, the same accounting policies for all the periods. Okay, entity should use the same accounting policies for all the periods. And this policy should be based solely on the IFRS standard in force at the reporting date. You have to see at the reporting date what is the IFRS standard. What was the policy during that time? Second, a major problem. What is the major problem when entities switch to IFRS standard? That IFRS standards also keep changing. Is it the same? No, right? That also keeps changing. So, an entity may apply an IFRS standard, okay, that is not yet mandatory if that standard permits early application. Maybe you can apply that early, but it is not yet mandatory. So you can apply that. Still, you can apply that when you are going for the first time to IFRS standard. Third, an entity's estimate at the date of transition to IFRS standard should be consistent with the estimates made for the same date in accordance with previous GAAP. Unless the estimates evidence says the estimates were wrong, it has to go by the same. Whatever the estimates you have done under the previous GAAP, it should follow this. Based on the same estimate, it has to be consistent when you're transiting from old GAAP to IFRS standard. Okay. IFRS 1 states that the opening IFRS statement of financial position must have these things, 4 things. Number 1, recognize all assets and liabilities that are required by IFRS standard. That means, according to your previous GAAP, there were some assets and liabilities that you couldn't recognize. Now that you have shifted to IFRS standard says recognize. So you have to recognize those assets and liabilities. Second, you should not recognize those assets and liabilities that IFRS does not permit. Third, you have to reclassify some assets, liabilities, and equity that are in accordance with IFRS standard. And you have to measure assets and liabilities according to IFRS standard. Okay. Now the third issue that needs to be addressed, how gain and losses are reported. All gain and losses that is due to the adoption of IFRS standard are reported directly in retained earnings, not in profit and loss. I repeat, all the gain and losses due to the adoption of IFRS standard goes to retained earnings, not profit and loss. Remember this point. Fourth issue was explanation and disclosure. Okay, entities must explain what is the impact of transiting from previous GAAP to IFRS standard. How can it affect your financial statement, right? Your financial performance, financial position, and cash flow. When you are preparing the first statement under IFRS standard, you will see that there are some error, right? So entity may identify errors that has been made in the previous year, correct? Now you have to correct those errors and separately disclose them. Okay, you have to, the correction of these errors must be disclosed separately. You cannot correct the error because it was under the previous GAAP, right? The errors. Now you have shifted to IFRS standard, you can identify some error, but you have to disclose those errors. When you are preparing statements in accordance with IFRS standard for the first time, okay, fair value of property, plant and equipment, intangible asset, and investment property. What are the three standards that we are talking about? IAS 16, IAS 38, and IAS 40. Okay, the fair value. This can be used as a deemed cost when you are preparing IFRS standard for the first time, the statements. If so, the entity must disclose the aggregate of those fair values and the adjustments made to the carrying amount under the previous gap. This is basically reading, okay? All this standard is basically reading stuff only. Just read one or twice until you're familiar with it. Just make yourself familiar. That's it. There is not much to do in this standard. In fact, this is one of the easiest standards. Some standards are very easy, very small and very easy standard. Okay, like IS 23, which is a borrowing cost, then government grant. All these are small and easy standards to deal with. Coming to exemptions, the fourth issue. See, these exemptions are there when the cost of complying with IFRS is more than the benefit. Okay, that time they have given some exemptions. For example, previous business combination, now you do not have to restate them. Second, any gain and loss due to the translation, okay, translation gain and losses, okay, on an overseas subsidiaries are nil, zero. The entity can choose that. They can choose the past translation gain and losses and an overseas subsidiary to be nil. Third, you do not have to restate the borrowing cost that was capitalized under previous UK GAAP at the date of transition. So these are some exemptions. Now, the last issue, implications of adopting the new standard. Before you adopt, you have to consider these issues. First one, you need a guidance. It's not easy to translate from one standard to another. You need a guidance. Okay. For example, there has been some changes, right? IS 17. Before leases was under IS 17. Now they have changed it to IFRS 16 with some changes regarding to finance lease. Okay. But remember, if no guidance is provided, then you have to apply IS 8. IS 8 is accounting policies, changes in accounting estimates and error. Okay. Second, bonuses and performance related pay. When you are moving to new accounting standard, it affects your profit. Affects your profit means your bonuses also gets affected. So this schemes you have to redesign now. Because you are moving to new accounting standard, even this schemes you have to redesign. IT system. See, your IT system cannot deal with complex recognition or measurement or disclosure, which is under your new accounting standard. Then covenant on loan. Why covenant on loan? When you're moving to new accounting standard, you might deteriorate some ratios like gearing ratio. Your gearing might be too high now. So because of that, you have to now renegotiate with the bank. Renegotiate with the bank on the loan conditions. Earnings per share. Because of your transiting from old to new accounting standard, your profit might go down. Profit goes down when earnings per share reduces. This is not a good sign. Why? Because this ratio is heavily used by investors. So make sure that this does not get affected. Perception. Analysts view the move to IFRS standards more favorable, right? And knowledge. You need to train your staff, for which you have to spend time as well as money. And you have to recruit new staff also if you need so, to deal with the new accounting standards. So all these are issues that you have to first go through before you decide whether it is suitable for you to adopt the new standards or not. Once this issue is solved, then you can move on with new standard. Now we'll be doing one question before we summarize IFRS 1. Test your understanding 1. Okay, you have been given 3 separate transactions and you have to deal it according to IFRS 1. This is the question. Okay, so you have been given the first set of financial statements will be for year ended 31st December 2005. Okay, now, so these are the following 3 issues. Before we go through the following 3 issues, tell me the date of transition very quickly. You should be knowing this. See, it is for year ended 2005. Okay, that means from 1st of Jan 2005 to 31st December 2005. Date of transition, when you look from this date, 12 months from here, 12 months back. That means it will be 1st Jan 2004. This is the date of transition. Okay. You have to know this. After this, we'll be moving on to the 3 separate issues. The first one, NAT received 5 million in advance. Okay. These products were not dispatched until 2004. In line with this previous gap, 5 million was recognized as a revenue. Tell me, according to the IFRS standard, which IFRS standard is applicable for revenue recognition? First, understand this. IFRS, I'm not writing the answer. The answer is there in your textbook. You can go and take your leisure time and read the answer. I'm just going to explain you the answer. Okay? You can read it and you can make up your own answer and write with my explanation. So IFRS 15 is applicable. What does IFRS 15 say? First of all, tell me whether you can recognize the revenue, whether they are correct or wrong. They have recognized this revenue. They have received 5 million in advance. First point. Second point, these products were not even dispatched. They didn't leave the place. They were still in the inventory. So tell me, can you recognize the revenue according to IFRS 15 under this condition? If it's yes, it's correct. If it's no, then the gap is wrong. It's no. You cannot recognize a revenue according to IFRS 15. Why? You need to give the reasons why. Because the product, the control of the asset has not been passed to the, it is still there. It has not been transferred to the customer. Okay, that's the reason. So now, what should you recognize instead? You have to correct this now. So when you're correcting this, what should you recognize instead? If revenue, then what? You have to recognize this as a contract liability. This is IFRS 15. We have still not touched IFRS 15. Okay, but when we go to IFRS 15, you can always come back here and see. Okay, that time we are going to learn this word. There are two words that is known as a contract liability. This happens when you recognize, when you receive something in advance. Okay, you do not recognize it as a revenue. Instead, it is a contract liability because you have to pay it. So you recognize a contract liability instead. Now, what to do with this 5 million? This 5 million was a revenue. Now it becomes a loss, right? So this 5 million loss goes to retained earnings. Because we told nothing goes to profit and loss, it will go to retained earnings. So this 5 million, it's a loss now. It's not a revenue. So when you're recognizing this liability, contract liability, it's a loss, this 5 million. So this 5 million loss goes to retained earnings. The second transaction. A restructuring, this is about restructuring provision. With standard IS 37. Restructuring provision of 1 million, okay, was recognized on this date in accordance with previous gap. But according to IS 37, it does not qualify for liability. So this is very easy because it directly says it does not qualify for a liability under IS 37. That means you do not recognize it as a liability, right? Because it does not meet, right? The provision does not meet the criteria. So now, what should you do? You have to de-recognize. The word is de-recognize. You have to de-recognize. Okay? The provision should be de-recognized. Now, when a provision is de-recognized, see, provision is an expense, right? When you de-recognize means it's a 1 million gain now. This 1 million gain also goes to retained earnings. Where will all this go? Retained earnings. So this The 1 million gain on derecognition of this provision will go to retained earnings. Third transaction. Net made estimates of accrued expenses and provision, okay, on this date. Some of these estimates turn out to be understated. Net believes that these estimates are reasonable and in line with the requirements of both its previous GAAP and IFRS standard. No number has been given, but you have to explain this point, the impact on the financial statement. Whenever figures are not given, you have to give the impact of it on the financial statement. Okay, so third transaction. Tell me, even though they turn out to underestimate, net said they are reasonable. Okay, that means no error has been made, right? Because he said they are reasonable and in line. That means error has not been made here, even though they underestimated. Okay, so now what is it? You still have to deal with IAS 8. The standard that you have to deal with is in IFRS is IAS 8. IAS 8. So according to IAS 8, how do you deal with this issue? Error has not been made, but it is understated. Okay. Prospectively. The word is prospectively. There are two words that we studied in IAS 8. Retrospectively, prospectively. Retrospectively means going back and changing the past figure. Prospectively means in the future you are going to change the figure. You are not going to go back and change the past figure. This came when we were dealing with accounting estimates and accounting policies. Right? So this you need to deal with prospectively. So any additional expense in the future, right, will be recognized. Will be recognized where? In the P&L. Additional expense will go to profit and loss. Okay. In accordance with IFRS standard for the year ended 31st December 2004. That's it. Now we'll be summarizing IFRS 1. So, the summary of IFRS 1, the top 5 points. Number 1, date of transition. How do you get the date of transition? When you have been given the year end, go to the beginning of that. For example, first set of financial statements for year ended 31st December 2002. So 31st December 2002 means starting is 1st of Jan 2002. So from 1st of Jan 2002, go 1 year back, which will be 1st of Jan 2001. So 1st of Jan 2001 is the date of transition. Okay. Second, which IFRS should be adopted? It's very easy. Look for the keywords. In the previous question, the first transaction was revenue recognition. That means IFRS 15. Second was provision, which is IAS 37. Okay. So you will know by the word provision, expenses or revenue, like that. Third, how gain and losses should be reported in IFRS standard when you are dealing with adopting to IFRS. All gain and losses goes to retained earnings, not to profit and loss. Okay, this is when you're adjusting. Except the last question. See, in the previous one, okay, you might be having this question that why in the last one it goes to profit and loss. The reason is the standard says you have to deal prospectively. That means in the future onwards. You don't have to deal with the past. If anything you have to deal in the past needs to be corrected, those will go to retained earnings. But once you have moved to IFRS standard, okay, from that day onwards, everything will be dealt in profit and loss, not retained earnings. Retained earnings only the past figure. In the date of transition. Okay, if you're making any adjustments, okay, for which gain and losses comes, that gain and losses will go to retained earnings. Okay. Fourth, explanation and disclosure. You have to disclose the fair value. You have to disclose. Then, what exemptions are available? There are 3 exemptions, I suppose, that are available regarding business combination, then overseas translation gain and losses, and regarding fair values of IS 16, IS 38, and IS 40. Moving to implications. Number one, practical implications are your training cost, IT system, planning project. Then, in terms of debt covenant, renegotiate with the bank. Regarding performance related pay, you have to redesign your scheme, and anything to do with profit figure, you have to make adjustments. Okay, that affects your earnings per share and etc. Communicate with the analyst on the expected changes to the financial statements. See, IFRS 1, when you're adopting it, will have an impact on the financial statements. This changes needs to be communicated with analyst. That's it for IFRS 1. And make sure that you go to your revision kit right now after this lecture and pick out all the questions for IFRS 1 and do it one after the other, one after the other, so that you know a pattern. If there has been no question on IFRS 1, okay, don't worry. Still, test your understanding. One is there, one question I've done here. So with that understanding, you can predict what type of questions might come. Okay, this type of question is not going to be hard at all. Okay, trust me. So thank you for watching and see you in my next lecture. That will be IFRS 2 share-based payment, another very important topic. So if you haven't subscribed to my channel, please do subscribe and also share this content, my channel, with your friends so that they are aware, and you can watch all my lectures on my playlist SBR lecture. Thank you.